So, good morning, everyone, and thank you for joining today's VitalHub Investor Webinar. My name is Corey Cohen of Virtus Advisory, and I am, of course, joined today by VitalHub CEO Dan Matlow and CFO Brian Goffenberg. Today, we will walk through the VitalHub story for about 20 minutes, followed by Q&A from the audience. Should you have a question, please use the Zoom chat function, and we will be sure to do our best to answer everybody's questions. On that note, I'd like to hand it over to our CEO, Dan Matlow, to begin the presentation. Dan, you can go ahead when you're ready.
Hello, everybody. Welcome today, and welcome to an overview of VitalHub from an investor presentation. This is something we haven't done in a while. We do selectively do marketing to brokers and to individual groups. We haven't sat and really given an update and just gone through a little bit more in depth with our investor presentation and just people trying to understand the story and where we progressed to date and some of the directions that we're going over on a go-forward basis. So we thought it would be a good idea just to reach out to the general public and get some updates to do it. So just a bit of an introduction. I'm Dan Matlow, the CEO of VitalHub, and joined with me is Brian Goffenberg, our CFO, and we'll answer questions at the end, but we'd like to take you through the VitalHub mission and story, and hopefully we'll get some dialogue going and some questions when we're completed, but we're happy to take questions. We really want people to understand our story because we think we're doing some great things. Next slide, Brian. You can help run through this. So as many of you may or might not know, we are a healthcare IT software based organization, and we are focused on what I'm going to call B to H or B to B type of businesses. So we don't sell to smaller based enterprises. We like to sell to bigger based government funded based organizations, and we're really focused on being a consolidator through M&A. As many of you might know, we've completed 11 acquisitions today, but we really are looking at targeted M&A for synergistic M&A growth. So M&A is an important part of our business model, and we'll talk about that as we go forward because we think it's important, but it is important that you understand it's very synergistic. We're really trying to build a common platform of solutions that we can cross-sell and cross-pollinate into our markets. So it's high organic growth, and we'll show that in a second. We think we've done pretty well in terms of our organic growth, and that's really been the biggest change over the last 12 months with our acquisition. We're in a strong financial position with our annual recurring revenue stream. It's over 21 million in annual recurring revenue at this point. A high quality customer base, about 400 base organizations across many large based government and mental health spaces throughout internationally. So good template of businesses. A great management team. I'm happy to be surrounded with a good board, good strategies to do that. So we're looking for that organic platform that allows us to cross-sell. Our solutions are very targeted for trends that we see with the patient flow inefficiencies in healthcare today. And we have a strong offshore R&D group that helps us in a cost-effective way get our innovation pretty strong. I think it's key to understand that we've done very well internationally. We don't believe a Canada-only story gives the ability to scale and the ability that our shareholders and us as investors would like to do. So we've managed to get a template, of course, in Canada, across the US, UK, Australia, and Mideast and Europe as well to do. So what do? We got 17 products in what we call patient flow software, as well as EHR case management. So we started in the EHR case management space. Those are solutions that are primarily led by a product we call Treat, which is our award-winning based solution in that marketplace. And we have 20 different modules across that platform with a strong representation in the Ontario, Canada marketplace. And we're starting to move that product internationally as well. And the growth area, which we think we're going to do a ton of work in, is what we call patient flow and operational visibility. And those are solutions that are really carved into two areas, which are patient journey solutions, solutions that help us as patients and consumers navigate through the healthcare system more effectively, and solutions that also give visibility into the hospitals into how we're doing and where our patients sit and how can we move them more effectively. But we see lots of opportunity for organic growth there as well. A little bit of some financial highlights to do. And I think it's important because we are a very financially driven based organization to do that. We're fiscally very responsible and we really watch our metrics very closely here. So we've accumulated annual recurring revenue stream over 21 million in revenue, and we add, that's about 80% of our revenue, which is really a milestone, which is extremely important for a SaaS-based, software-based company. So we finally hit that mark in terms of getting stuff. We got very minimal or zero debt in the company. We have the ability to use debt through financial instruments that we put in place, but at this date, we don't do that. We've been vetted through our capital raises by a lot of institutional investor bases. Some of them may be on the call today, but I think it's more the terms of the retail investor that is on the calls today. But those institutions have gone through a ton of work in terms of looking at what we have, and we've really vetted our story. We're in a strong financial position with 17 million on cash on hand approximately, and we have facility for more debt financing through tier 1 banks that have vetted us again to give us great financial terms that we can use for M&A for us. We're cash flow positive. We produce cash as an organization. Our trailing 12-month organic growth of our ARR, annual recurring revenue stream, has been growing at a 30%. We're adjusted EBITDA positive for the past 9 quarters, and that gets progressively increases on a quarter-over-quarter basis. We use adjusted EBITDA as our marker, as we've done a lot of M&A, and we have a lot of non-cash based items on our income statement, which need to be looked at. Adjusted EBITDA allows for really good mapping of how we're doing on that. And we are 100% a software organization. Yes, we do implementations and so forth, which represent some of our revenues, but our gross profit percentage compared to other healthcare IT stocks that aren't really healthcare IT stocks that actually buy brick and mortar and other low margin based business, our gross profit is at above 75%. So we're crossing all those lines and all those check marks that you really want to look at for a high performing SaaS based software company. And I think it's important that we highlight that. Again, a more validation of our successes. We made it through to graduate to the TSX a few weeks ago. We're proud of that mark to do that. It's a hurdle. Again, more compliance, more meeting those base things. Again, another step in our journey, but we graduated the TSX, another vet, which leaves an immense amount more of opportunity for us to grow. A little bit about the history of what we've accomplished since going at this in 2016. The light blue things would represent the EHR case management based products that we've acquired, and the darker subjects would be our patient flow based products. But we started in 2016 with the 2 companies called Hynix and B Sharp. Hynix has a product called Treat, which is a go-to product in that particular marketplace, and we've amalgamated other products into that product base as well. But Treat has progressively become the leading product in what we'll call the community agency mental health space space to do that. So it will provide services for a lot of the community agencies within the Canadian marketplace. And we're seeing consolidation of those things in the marketplace where Treat is starting to win a fair amount of RFPs, and we expect to see continue to grow. And in 2018, we closed a large government deal with the province of Nova Scotia, which is a 10-year contract, which we expect to grow to 2.5 million of recurring. So of the 21 million of ARR we have in place, only 500,000 of that still comes from Nova Scotia. We expect another couple million over the next while to start coming in from that thing as we continue to roll out that solution. In 2019, we entered into what we call the operational patient flow and visibility space. And I'll take you through what those products do, but we really are at the sweet spot of where healthcare IT in the periphery with having these solutions. Hospitals have really gone through and have built their EHR, their core-based systems, and are starting to look at these periphery systems. But as mobile computing and things like touch screen-based analysis and web-based computing all start coming to head, the ability to see and get analytics where patients reside and how they're moving through the entire healthcare, what we call continuum, all those groups is a #1 or right near the top of the list for hospital CEOs and government-based groups that are really trying to figure out how we have this overabundance of patients and how we move them through the system. So our goal is to continue to fill gaps in our product set in the patient flow-based arena. We've already filled a lot of those gaps and are starting to fulfill those things. But we started with buying Oak Group, a UK-based company, which has clinical-based criteria, which makes appropriate care decisions for patients in a large install base in the UK with footprints in Australia and the Mideast. Oculus is a Canadian-based thing, which is operable management-based solutions that are used by hospitals to do that. Look at things like bed boards and displays within hospitals of which they can look at analytics that help senior execs understand where their patients are within their hospitals. In Touch with Health and Transforming Systems were really our two transformational acquisitions that we made in the UK. It allowed us to start moving in the UK marketplace. But In Touch with Health is what we call patient journey software. Those are solutions that we as patients use to help us navigate into things like outpatient labs, outpatient facilities, into the hospitals and pre-operative based assessments before we come in there. A very hot topic within healthcare today, and as a result, we're seeing large organic growth within those particular sets. Transforming System, another system that lets us get through into the operational visibility solutions, but more from a regional based perspective. How are regions doing from a patient flow perspective? JX is a competitor in Touch, so we took out a competitor already. Large implementation base in the UK and Australia. It's really given us a foothold to get into the Australian marketplace. And then recently we pushed into the Alimax system, which is complementary to the Oculus and Transforming System of providing another form of rich analytic data for helping hospitals, again, with a nice install base in the UK. S12 is more on our community mental health agency space, but it's a mobile application that finds healthcare workers, healthcare clinicians in a time of crisis for mental health patients. And that product has grown to a footprint of 70% of the marketplace in the UK with a huge ability with that platform. It's a full-blown SaaS platform to continue to add services that we can add cost to in those particular areas. So lots of opportunity for growth there. Next slide, Brian. Hang on. Okay. So I'll go through these quickly, but the Treat product and the EHR product has a base of about 175 of our customers, all within the Canadian-based marketplace. We're looking to build that. The Treat product has gone through extensive amount of IP development through the Nova Scotia contract and things that we do, and we really believe with the RFPs that we're seeing on the street starting to go that this product's going to do extremely well in the future as we're starting to see all the development that we put into that product take shape as we're starting to win these RFPs. The organic growth, again, focused on the patient flow operational visibility space. I touched with it. Again, the patient journey software, huge issue in terms of moving patients through hospitals, giving patients tools to do things like pre-operative based assessments at home, helping you navigate into a hospital by giving you appointment scheduling, helping you once you get to the hospital, find your rooms, all those based solutions that help you once you get into the hospital, and a lot of analytic-based solutions, BI, artificial intelligence-based solutions that help hospitals with the operational visibility things, run things like command centers and operational visibility boards and analytics that help senior execs and people understand where their patients are residing within the healthcare continuum. So patient flow outcomes, from patient flow really focused on things like demanded capacity, healthcare optimization, getting a whole system visibility, understanding patient activity, doing things like virtual consultation so we can do things from home, operational management when we see the boards, and pre-operative care are really the 8 pillars that we look at outcomes from patient flow outcomes. And we're starting to build and aggregate those solutions, and we're starting to see that really help in our organic growth-based structures. Some of the products, as I mentioned, we got lots of different products in the patient journey-based solutions. You can see things like iReceptionist, where you can see a receptionist on a phone or a kiosk versus going and seeing an iReceptionist when you walk into a hospital. Wayfinding maps within your hospital, virtual clinics to let you do things at home, mobile appointment managers, understanding patient activity, managing rooms when you come in for an outpatient-based visit, hospital check-in when you check into a hospital-based stuff, doing preoperative based assessments when you're at home before you come in for elective surgery with our Synopsis product. Next slide. The marketplace size, we look at things across beds. It's about 3 million bed market that we're targeting within the Canada, Europe, Mid East, and Australian markets. Average price about 700 bed. It's a large opportunity, and we're starting to impact that. A little bit on, I've explained this on our M&A strategy, the other part of what we do. Our strategy is to rapidly increase growth and profitability by combining like software companies in the arena. And we've been proving that with the 11 acquisitions we do. But we have the ability to leverage more innovation by reducing R&D spend with our offshore development group in Sri Lanka. We have a team of 70 people offshore in Sri Lanka. It's our people that do that, and we own that group. We consolidate G&A. We cross-sell our products really effectively. We optimize our sales and marketing into more of a strategic story, and that leads to just more organic sales, which we're starting to show. We've identified 400 targets. We have the abilities of reducing costs through synergistic-based stuff. We target companies between 1 and 12 million in revenue, and we're looking to be a company at 20 to 30% EBITDA. We're already at last quarter, we're at an 18% adjusted EBITDA, and we keep working on that metric as we keep getting more organic growth. Again, we're adding more organic growth at 75% gross margin. As those sales come in, we expect that to start hitting our EBITDA and adjusted EBITDA market. We've been using a combination of cash and stock, a lot more cash recently than stock, but we do have that ability to use the currency as part of our acquisitions, and we will as required. We've been buying things between 1 and 2.5 times revenue, about a 3-time revenue of recurring. So we think we're being accretive through those acquisitions. We look for companies with recurring revenue above 60% of revenue, break even or profitable based businesses, or soon will be. They tend to be owner-operated businesses that want to grow with scale. So they join our operations to get the cross-selling based opportunity. Large expenses on R&D, so we have the ability to help them out with that. Little commercialization or sales experience that we can assist with, and limited expansion within the geographical boundaries. So we like to bring the solutions from one geography to the other. Go ahead, Brian.
So some of the numbers. So these are revenues for the last 11 quarters. As you can see, we've been growing quite nicely, both through organically and through acquisition. And we like to measure the growth in organic revenue, or the amount of organic revenue in any quarter, because we feel we're not just an M&A play where we are able to take these properties that we acquire and grow them. We've got a pretty strong management team with great operational experience. So if you can look at, we've ranged from anything from 29 to 53% of organic growth in any quarter. We want to see that number continue to grow as we go forward. And, I think it just shows that we can do both grow through M&A plus operate these entities that we acquire. As Dan said, a big metric for us is recurring revenues or annual recurring revenue. We want to get to 80% of our revenues being recurring revenues. We're pretty much there, and we want to continue to maintain that. We think it's high margin revenue and de-risk the business significantly. So you want to see that continue to stay up at those levels and grow. As Dan said earlier, we look at adjusted EBITDA, and the main reason for us using that metric versus profitability is we have a large amount of amortization from the acquisitions. So if you look at any quarter, I think we've got over about 500K in amortization, which is a non-cash item, and just is going to go through our income statement on a quarterly basis. We've been adjusted EBITDA positive, and we want to get that number closer to 20 to 25% as we go forward. We're really trying to mirror the rule of 40, where we want to make sure our adjusted EBITDA is between 20 and 25%, and our growth between 20 and 25%. So we've done that consistently, and we believe that the adjusted EBITDA for the most part mirrors cash flow. So it really shows the amount of cash we've been able to generate. The only cash item that flows through there is the one-time charges. And that's just another way of looking at it. You can see we've adjusted EBITDA positive, revenues growing, and the business is pretty solid. As Des said, we believe it's responsible growth. We want to make sure that we are generating cash from operations. We'll take the surplus cash and use that for M&A activities. Our ARR, we're very proud of where we are with ARR and how it's grown, not only through acquisitions, but through M&A. As Dan said, the last 4 quarters, we've been north of 30% of organic growth through in our annual recurring revenue, and we've grown through acquisitions as well. So we were sitting at the end of Q2 at 19.8 million with the Alamac acquisition. That takes us to about 21 million, and we think we're north of that now. So continue to monitor that and watch that grow. Our cap table, we've got 36.7 million shares outstanding, 2.4 million options, which could bring in another $5 million, 1.3 million warrants, which could bring in another $4.5 million. So at 314, I think we're closer to about $3 now, but at 314, we had a market cap of 115 million, no debt, $17 million of cash on hand. So if you take that at an enterprise value of 98 million, and with revenues of about run rate of about 27 million, we're only trading at about 3 times, just north of 3 times revenue, which we think is pretty modest. The shareholding, management, and the board controls about 27% of the equity, and the public 73%. Of the public holding, I think about 50% of that is probably held by institutions. We have a really strong institutional shareholder base, which we're pretty proud of. Burgundy Capital is probably the largest shareholder. Don Kent, Maxim, a lot of institutions who like the story and have been able to participate. We're presently covered by 5 analysts, all have buy ratings between 4.25 and 5.35. Dan talked about the Nova Scotia deal. To date, we think that can bring in about $2.5 million of annual recurring revenue. To date, it's only bringing in about 500K, so there's a huge amount of upside there of another 2 million, which will come in over the next couple of years.
Yeah, so just to summarize before we take some questions, the marketplace is huge that we're dealing with. It's the international-based marketplace. We have footprints in all those marketplaces with a team that really understands how to get to those marketplaces. A history of M&A that is done there with 11 acquisitions, strong ARR growth with the high quality customer base. We have all the blue chip hospitals and the geographies that you would have. People at Healthcare IT would recognize these names, and we're really proud of the customers that we did. The team is both experienced on the board in terms of running healthcare IT software companies. A lot of people of us have been working in the sector for a long time in international-based marketplace with bigger companies, and we know how to grow these particular businesses. Our board has extensive experience in M&A, capital markets, and running healthcare IT software companies. We have an offshore development group, which is a 70-person team, which is innovation of excellence, which really gives us a competitive advantage for building cost-effective, innovative-based solutions. So we're excited about how we put all this together, and we keep progressing to the next levels, and we're open to questions.
Great. Thank you, Dan. Thank you, Brian. Just a reminder to everybody that if you do have questions, please use the chat function on the bottom of your screen, and we'll do our best to get to them. Keep in mind, we do have a number of questions that came in advance, but here we go. Our first question asks, any plans of growing into the other 4 major European markets, including Germany, France, Italy, and Spain? And furthermore, is COVID still a negative impact within the Canadian market?
Yeah, we do have plans to move into the international marketplace, and we do have implementations, and we are actively looking to enter those markets. Ideally, we want to enter those markets with acquisitions, so we are looking for those companies, and we know those companies, and we continue to look and have conversations with those companies that would be synergistic to what we have to offer and bring those values to it. So Europe is a big part of our market. We think there's an opportunity for a lot of our solutions to go into that marketplace, so we do continue to look at it. COVID has both been positive and negative, and it's hard to really put your thing on it. It's been difficult to get people's attention and move things along on one part of the equation, and the other part of the equation is really increased awareness for what digital solutions such as the solutions that we have to offer really highlight the impact of what it can do in those markets. So it is there. We do think people are getting back to work, and we are seeing the effects of understanding the effects of digitization. They're a little exhausted from the implementations, but we are seeing as they come out of the summer that it is starting to become business as usual, and we are seeing our activity increase. So we are moving in the right direction there.
Great, thank you. Our next question asks, you recently announced a credit facility. Can you discuss how you intend to pull on that if needed? And if it's for acquisitions, can we expect higher cash payments and less dilution from equity?
Yeah, cash is still the vehicle that we would predominantly use for acquisition. That's why that facility is there, and we do like the terms of that facility. It's a 10-year amortization, which is what we were looking for, where we can really use cash flow to pay that back with really nice interest rates. And we think we can call on increasing that facility very nicely. So we will use that facility as needed on a go-forward basis. We're not the organization that wants to put it at risk, our organization at risk, but we do think we have cash flow that can easily maintain those facilities on a go-forward basis. We will use stock as needed. It is an effective solution to help us do in acquisitions, to help us keep the principals on board and have them join into our mission. So we will use those when needed as part of what we do, but we don't expect to be using stock in the same way we have traditionally in the past as we continue to move forward.
Excellent, thank you. Taking a step back for a second, back towards expansion, any plans to expand in markets within Asia or India?
Not right now. We've done a little bit of work. Hong Kong is a market that we do look at because it is based off of the British healthcare system. So there's still a fair amount of things going on in Hong Kong. We are looking at through some distributors for like the EHR case management product where we see that. So we do see markets like that as emerging to some degree. Again, our ideal way to go into those markets is with acquisitions. I'm not saying no to those markets, but not right at the present. No, we have enough markets in where we're addressing.
Right, got it. Okay. Our next question pertains to the acquisition pipeline. What size revenue companies do you typically look at, and is there any particular solution within that pipeline that is particularly attractive at this stage of the company?
Yeah, we'll look at anything, I'm going to say from $1 million up to 20 million would probably be the spots that would, 20 to 30 million would be there in terms of that. But and we'll do that. We have the ability to do small acquisitions because we have the ability to operate companies where typically private equity based groups might not have that ability, and they're just looking for to get into those particular markets and just run them. So we have the ability to run those companies if needed. Smaller companies would be scared. So those companies definitely are a lot easier for us to acquire, and we have lots of those in the work. We do want to do transformative type of acquisitions, and we really got our laser filled on that for acquisitions that gives us a little more scale and size and depth. So ideally, that's where we want to go. Those aren't as easy to get, and we know the organizations that would be helpful in terms of filling gaps in our offerings. In terms of some of the gaps, things like appointment scheduling are things that we want to focus on a lot more on that journey software solutions that help patients at home navigate through to particular hospitals are solutions that we like. We like analytic-based solutions as well that would get outside of the hospital and get more into the regional-based worlds as well. We're more on the elective surgery. We think that's a big area. A lot of backlog in terms of what patient journey and patient flow software can do. So things like e-referral and things that help refer patients from one area to the other are areas that we're focused on as well. So we do have looking at those type of solutions.
Excellent. Just a reminder to everybody that they can use the chat function on the bottom of their screen to ask additional questions. Our next question asks, regarding capital allocation, when making an acquisition, what is your process for deciding whether to utilize cash, debt, or equity?
Cash and debt would sort of come into the same direction. Yes, there's less dilution in that thing. We really look at acquisitions from what it means to us, as opposed to what it does. So what can we do with the acquisition? Can we grow it organically? Can we integrate it effectively? What's the cost base? What type of gaps does it fill in our offerings? Really predominantly drive what's doing that. We're looking at how much we can sell, what that payback would be. All those economics are done, and we really have a M&A committee that vets those things, and we really scrutinize these things pretty effectively before we go through the acquisitions. Equity is primarily used as an incentive plan for the principals that have an interest of really getting into our journey and really want to come with us on that journey to get to the next level. So we tend to escrow the stock over the period of time so it doesn't get released. So the principals are part of us and they help grow our solution. So that's where we'll use equity where needed.
Right, that makes sense. Sticking with acquisitions, you mentioned earlier you target companies that have at least 60% recurring revenue base. For those types of companies, is there a margin threshold on the recurring revenue base that you'd be considering?
Well, intuitively, recurring revenue, if it is pure software recurring revenue, should be high margin based software. We've been showing gross margin at 75% of what our revenue is at this stage in the game, mainly because of our higher level of recurring revenue, and that's standard in the industry for SaaS-based businesses. So we hit that metric, and we like that metric. We need the businesses that we acquire to either be there when we get them, or more importantly, we have the ability to get them there. And we get the ability to get them there by understanding cost structures and synergistic based stuff, but more importantly, can we cross-sell and increase that more, get the sales up in the particular areas so that we can get more of that gross margin. So we look to get to that 75%. We want to maintain that 75%. It's an important metric for us.
Right, that makes sense. Speaking of cross-selling, can you expand on the cross-selling opportunities for solutions that may exist in one market like the UK and what that takes to move into another market like Canada?
Yeah, we got examples. Transforming systems is one of our higher performing based product sets that we got out of the UK. It's in about 35-40% of all the regions of UK. And what that solution does is give senior execs within the NHS, which is the healthcare authority there, to get visibility, not just of one hospital, but groups of hospitals and community-based facilities on their performing. So we can understand things like ambulance loads and patient volumes and elective surgery backlogs, not just from one facility, but from multiple facilities that are there. Now, we don't have that concept in Canada that we've seen today. So we have introduced it to Canada. We did announce our first deal a quarter or so ago with the triple CIUS out of Quebec, which also is our first Quebec deal. But we have introduced that product into the marketplace and have introduced it into our Oculus base, which is a product similar, but just on a hospital-wide basis. So we're seeing some synergistic value to that based initiative. The Synopsis product out of the UK also doesn't have that concept. We don't have a concept in Canada where we can do pre-operative based assessments from home on tablets before we go in a safe clinical fashion. So we've introduced that market in the Canadian marketplace. Simultaneous to that, our Treat EHR case management solution is being looked at by groups within the UK, because the marketplace, we think, doesn't have that type of product in that particular area with that robustness. So we're starting to see that, and we have a lot of customers which we can test ideas off of, test markets with, and we're in that process of doing that, and we're starting to see some results that are coming from that.
Great, thank you. Moving on a little bit to the financial segment of the business, capital markets, I should say. Any plans to uplist on a US exchange such as NASDAQ in the near future?
Yes, first step was getting on the TSX. We need to get a little, if we can get a transformational acquisition or keep going on the organic growth level, we would definitely be in the world to going on the NASDAQ exchange. We think we have the proper contacts. We're starting to get the profile to be able to do that. We need a little bit more size and substance, but I wouldn't say no to that. It's definitely, it's probably the next step that we would go to now that we're on the TSX. I wouldn't say it's going to happen overnight, but that is something we would definitely look at.
Got it. With $17 million in cash, access to the credit line, EBITDA positive, is it reasonable to say that there isn't particularly a need for a equity financing at this point anytime soon?
That should take us, what we have on the later ability to adjust and ability to use currency if needed to some degree, we wouldn't have to do an equity financing per se. That doesn't mean never is never in that particular world. If there's something that makes sense to us and it's a smart business to buy, and it's going to get us the 1 + 1 = 6, and we get it and we want to do it, and it's transformational, and we need to go to the markets, we would need to do that. But in the short term, based on some things that we got on the table, we're not seeing that, but that doesn't mean never. We always have the opportunity to do that if needed, but what we have on the table will let us get to a certain point for sure.
Excellent. Since we're pushing up on time here, I'll ask one last question. On yesterday's news announcement, the customer win, any more color you can provide on that?
The summer months, July, August, from a news flow perspective, is a little slow. September is usually a good month for us in healthcare. So, we continue to want to announce deals, and we'll continue to add deals. We try to give guidance on a per bed basis of what things cost on a product per basis. A lot of our customers, or most of them, do not allow us to put financial metrics into that. We sell to government, so we're sort of restricted on that. We're also really careful of our competitors understanding our pricing schemes and so forth. So unfortunately, we can't provide as much color in our press releases as we can to do that. But we should know that we tend to sell larger based organizations for the most part. You need to look at the size of the organization and the amount of patients and beds that they serve. You should get rough outlines, and if you read our MD&As and read our financials, you should be able to glean some light into doing that. The analysts, we got covered by 5 analysts, really got a good handle on that for those that have access to those reports or can do that. But we try to provide color. If you follow our company, you should get good insight into understanding that.
Fantastic. Well, that's all the time and all the questions we have for today. So if there's any closing remarks you guys want to provide, feel free to go ahead and we can close up shop here.
Yeah, just we want to get out to the public in terms of doing that. We are starting to increase our IR. We want to get more liquidity going on in the stock. We understand the need to do that, and we're excited that COVID is behind us in a fair bit, and the summer's behind us, and we're really entering the busy season of our business. Traditionally, Q4 and Q1 are better quarters for us in terms of adding organic growth, and there's a lot of activity within our base, both from an M&A perspective and from a growth perspective, and we think we're in the right direction, and we ask people to keep following our story and keep moving in the right direction.
Dan, Brian, Thank you so much for the time this morning.
Thank
Thanks
you.
everybody for joining.
Thank you everyone for joining us.
Bye-bye.
Bye-bye.